What if I told you there isn't just one way to buy a house, but there's actually 5 different ways to do this? Most people only hear about the last one. So if you're thinking about buying a home, you've probably been led to believe that your only option is to get a traditional mortgage. In this video, I'm going to break down 5 different ways to buy a house so you can understand all your options and make the move that works best for you. Today, we're going to cover 1, paying cash, 2, assuming an existing home loan, 3, seller carry financing, 4, subject to or wrap financing, and 5, that traditional mortgage. By the end of this video, you're going to have a clearer picture of what's possible. All right, so let's dive in. First, paying cash. Well, this is the king with regard to the ability to leverage, right? So cash is king in the sense that generally when you have cash, you can close quickly, which is attractive to the seller. You might be able to negotiate a lower purchase price because, again, the assumption is that with cash, you can just make things happen. There's less risk of the loan falling through during the process before close of escrow. So, cash is king, but I want to throw out there that, what's the downside of paying cash? Well, the downside, depending on where you are with your overall asset profile, is just you're tying up that amount of cash in a property that essentially, once you pay cash for it, it's not working for you. And so some would argue that it may make sense to leverage that cash and put that into an instrument that's growing. Now, does real estate appreciate and grow? It does, but it's not liquid. So if you pay cash for a home today and you ever want to go back in and access any of that cash, then you're talking about putting a loan on the home, which is going to have interest rate and cost associated with it. Now, the cool thing about paying cash is sometimes we have buyers that have the cash, but they don't ultimately want to just have a free and clear property. They want to get into this leverage mode. There's something called a delayed financing approach here. It's kind of the best of both worlds. So to allow that buyer who has the cash to win on the negotiation, to do a fast close, and then they can come in within a period of time after closing and put that ultimate lien, that mortgage on the property and get some of that cash back. So that's a win as well. But cash, if you have it, awesome, if that's what you want to do with it. Now let's move into number 2. Number 2 is assuming an existing loan. Now this is really popular, especially when mortgage rates go higher. And remember, rates are cyclical, real estate markets are cyclical, but as mortgage rates get higher, some would look at, hey, can I assume somebody's existing home loan that might be at a lower interest rate? Government-backed loans are assumable with qualifiers, and this is a really cool strategy. If you find a home that has an FHA, a VA, or a USDA home loan on it, it's very likely assumable. You'll have to go through the qualifications with the current lender on the property. Assuming that you can qualify, you could assume that interest rate. And we're assuming that that interest rate is lower than current market rates. And so that's why there are certain market cycles that really dictate knowing about the assumption of an existing loan. Now, one thing I didn't address is conventional financing. And so traditionally, conventional financing, Fannie Mae, Freddie Mac, it is not an assumable loan. And that bodes into some of these other things I'm going to talk about later. When we get back into the government-backed assumption, it's really about the numbers. So let's think this through. Let's say the seller has a mortgage with a balance of $300,000. Let's assume that that interest rate is 30-year fixed rate at 3.25%. But now the seller wants to sell that property at $500,000. Well, yes, you could look at assuming that 3.25% interest rate with that current loan going through their existing lender, but how are you going to come up with the difference between the existing balance on the mortgage and the purchase price? Now we're talking $200,000. You could come up with that cash out of pocket. You could look at some type of secondary financing if the lender that you're assuming the loan would allow for that. There's other ways you could do that, but really that's always the rub. It's just, sounds great, I can assume that 3.25% interest rate, but what are you going to do to cover the difference? Now, maybe there isn't a difference. Maybe it's, a balance of $300,000 on that mortgage, and maybe the seller's selling you the house for $325,000, something like that. Then that makes it a little bit more workable. But there's so many different variables that go into each one of these scenarios, and that's why I'm spending time to talk with you about them. Okay, seller carry financing. This happens all the time as well. Let's say the seller has a free and clear property and they want to earn some interest income. So they may be willing to act as the bank or the lender and allow you to purchase the property. They would be putting the note on the property and you would be paying the seller your mortgage payment. Generally, these work on shorter term scenario. So maybe that's a 5-year or a 10-year type of scenario. Maybe there's a balloon after that initial term, but that's how it works. Interest rates are generally market rates, could be a little bit higher. And so you're sitting here thinking, why would I use a seller carry? Well, your closing costs could be lower when compared to a traditional mortgage. Your credit qualifications could be different when compared to a traditional mortgage. So let's say maybe life has happened to you and you know the seller and they have confidence in your ability to pay them, then maybe they would consider doing a seller carry for a period of time and get you into a position where you could eventually take out that traditional mortgage and pay them off. So it's a tool, but in most cases, it's not really used for a long-term, kind of like a 30-year scenario. So generally, sellers that are doing this are just thinking short-term interest income, and the strategy is always about what's the exit strategy look like and what's the time period to have that exit. So, they work. And again, lots of conversation around those, but you would need to have a seller that has a free and clear property that's interested in doing this. Let's say that you have identified a seller and they are willing to do a seller carry, meaning that they're going to be the bank, the lender, there's going to be a note, there's going to be a deed. What else might you consider? Working with a title company to ensure that that property is truly free and clear of any liens. You want to have that title insurance. And so I would highly recommend partnering with a title escrow company. So it feels traditional in the sense that when you go through a traditional mortgage, that's what's happening. You go under contract with a seller, then your real estate agent is going to go open escrow, which is going to initiate the title insurance, the title search. It's going to come back and give you a preliminary report of the liens on the property and the conditions for that title insurance to be enacted and for that loan to close with title insurance. So there's a whole process, and I highly recommend if you're going to do a seller carry that you employ a title company and an escrow company to kind of take you through what is similar. It occurred to me as I'm talking about all of this that at the end of the day, whether you're the seller or the buyer, what's really important to think about is what is the risk? What is the risk? Because sometimes, and I see it all out there, and there's people out there promoting all these things, but always just ask yourself, what is the risk? And that's okay to do that. What is the risk for you as a buyer? What is the risk for you as a seller? Write it down, get clear on the risk. And then if you decide to proceed with one of these options, at least you have clarity around the risk to you. And a real estate agent is always very helpful with this as well. But I think sometimes people get so excited about this new and, unique and, not traditional financing strategy. And then they get into it. They're like, holy smokes, there's a whole lot going on here, because some of these things can be very complex. All right, let's get into number 4. When I think about complex, this is probably the most complex one out of the 5 options. And that is a bind subject to, or what I call a wrap. Here's how it works. You have a seller that has a loan on the property. It's very likely a conventional home loan. It doesn't have to be, but let's just say because conventional loans are not assumable, we see it most often used with conventional loans. And so you have that conventional loan on the property, and they are going to sell the buyer their house, and the buyer is going to take over the payments on their mortgage. Now, this is not an assumption. This is not a refinance. Let's break it down. When the buyer buys the property, they go into and on the title. So now the buyer has ownership interest of the property, but the mortgage is still in the seller's name. And it's very likely that that seller's lender has no idea this is going on. Why is that important? It's important because that deed has a due on sale clause, which means that if the lender finds out about this, that they can call the seller's note due and payable. So what do you do then? You're a buyer, you technically own the property, but you're in no relationship with the lender. The lender's calling it the note due and payable, so you got to scramble to figure out how to refinance that note before the lender proceeds with the due on sale clause or the due on transfer clause. So there's like things that are going on there. Maybe that's okay. Maybe you're in a position to refinance, but what if you're not? What if you're a buyer that is going into this equation because you maybe can't get traditional financing? Just thinking through that layer of, okay, what happens if? On the converse, think about it from a seller perspective. You are selling the property to a buyer. Why isn't the buyer using a traditional loan, first of all? Secondly, what happens if the buyer defaults? Now the buyer owns your house, but you're still obligated on the note. So as you can see, we start to unravel all these types of like little what ifs, and I get it. Like, what are the chances? Well, the chances are probably fairly low, but I don't have the statistics to back that up. And if it were me on either side of the equation, I would really want to assess the risk. What if the seller files bankruptcy, but you as the buyer own the house? You have nothing to do with that mortgage, and that mortgage gets tied up in the bankruptcy. Now what? You're probably now going to get involved in that bankruptcy. So a lot of moving pieces here. I highly recommend that if you're interested in a subject to or a wrap type of financing, please check out the video in the comments that I did with Patrick McQueen. He's a local real estate attorney here in Arizona, and it is chock full of all of the what ifs and the insights, and he was valuable. And that video gets so many views because it's really just concrete. It's all the things that people don't tell you about subject to financing. So check it out if you're interested in that type of financing. Okay. Traditional mortgage. This is what we all probably think of when we think about financing a house. If you don't have cash and if you're not wanting to explore the assumption, the seller carry, or the subject to wrap financing. And a traditional mortgage would be working with a lender, going through that pre-qualification process. They're going to pull your credit. They're going to have you complete that application with all the information. You're going to provide documentation. The lender's going to assess your credit profile, your ability to repay. This is a big one. At that point, you have your pre-approval and you're ready to move forward with identifying the property you want, and you go under contract. And at that point, whatever that time frame is, 2 weeks, 30 days later, you close. In that scenario, the seller is completely paid off and they are out of the picture. They get their money and they move on. In that scenario, as a buyer, now the mortgage is in your name and the deed is in your name. You own the property with a lien on it, but you still now are the rightful owner of the property. So it's much cleaner, if you will. It's just black and white, and there's not a lot of this additional risk other than, what's the risk? Well, the risk is if you can't pay your payment, then you'll have to figure out what to do with the house. You could sell it, assuming that there's equity in the property. You could work with your lender on some type of modification, depending on what's going on in your life that may have caused a situation where you can't pay, etc. But it's your lien. It's no different than any other creditor that you might be entering into an agreement with, and the responsibility is to pay the payment. So those are the 5 different ways to buy a home, and as you can see, there's more than one path depending on your goals, your finances, and your timeline. But if you're leaning toward the traditional mortgage route and you want to really understand what do you qualify for, what does a payment look like, and how to structure the best possible loan strategy, that's exactly where the Kelly Zitlow Group comes in. A quick 15-minute call can give you that clarity and the direction you need, and just a real plan to kind of move forward with confidence so you know exactly what the next steps are. If you're ready to take that next step, call or text 480-725-0150. We'd love to help you get on a path to homeownership.